The Elder Force Index is a technical indicator developed by Dr. Alexander Elder. It was created by Dr. Alexander Elder, an experienced trader and author. The Elder Force Index measures the power behind price movements by combining two essential components. Let's visualize how the Force Index relates to price movements. The Force Index analyzes how price changes over time. It then combines these price changes with volume to create the Force Index indicator. Traders use the Elder Force Index for several key applications. It helps confirm trends by showing the strength behind price movements. It can spot divergences, which often signal potential market reversals. And finally, it can identify potential market reversals, giving traders valuable insight into market direction. In summary, the Elder Force Index combines price change and volume to measure the pressure behind market movements, helping traders make more informed decisions. This powerful indicator is a valuable addition to any trader's technical analysis toolkit. The Elder Force Index is calculated using a remarkably simple formula that captures both price change and trading volume. The formula multiplies the volume of the current period by the price change from the previous to current period. Let's look at a practical example using 5 days of trading data to see how the Force Index is calculated. For day 2, the closing price is $105, volume is $1,500, and the previous day's close was $100. The price change is positive $5. To calculate the Force Index, we multiply the volume of $1,500 by the price change of $5, giving us a Force Index of positive 7,500. The Force Index rises when prices increase and falls when prices decrease. Let's see this relationship on a chart. As the price moves up and down over these 5 days, watch how the Force Index responds to each price change combined with volume. The Force Index has several key characteristics that make it a valuable technical indicator. The result is positive when price rises and negative when price falls. The magnitude of the Force Index increases with both larger price changes and higher volume, indicating stronger market force. In this section, we'll learn how to interpret basic Force Index readings. Let's start with a price chart showing typical market movement. Below, we can see the corresponding Force Index. The horizontal line at 0 serves as our reference point. Positive Force Index values indicate buying pressure, signaling bullish market conditions. Conversely, negative Force Index values indicate selling pressure, reflecting bearish market conditions. The magnitude of the Force Index reading indicates the strength of the move. Large positive spikes suggest strong buying pressure, while large negative spikes indicate strong selling pressure in the market. Near zero readings in the Force Index suggest market equilibrium or indecision, where neither buyers nor sellers are dominating. To summarize, the Force Index helps us interpret market conditions. Positive values signal bullish pressure, negative values indicate bearish pressure, and the magnitude tells us about strength. Small values reflect weak momentum, while readings near zero suggest market equilibrium where neither buyers nor sellers are in control. The raw Force Index often presents challenges for traders due to its high volatility. To address this issue, traders typically apply an exponential moving average, or EMA, to smooth the values. Here we can see the raw Force Index with its significant volatility, making it difficult to interpret clear signals. By applying a 13-period exponential moving average, we smooth out much of the noise while preserving the significant trends. This is commonly used for intermediate-term analysis. For short-term trading signals, a 2-period EMA is often preferred. It's less smooth than the 13-period EMA, but more responsive to recent price movements. Smoothing the Force Index offers several key benefits. It filters out market noise, highlights significant trends, and helps identify meaningful reversals. When choosing which EMA period to use, consider your trading time frame. Longer periods create smoother lines but respond more slowly to price changes. Shorter periods are more sensitive but may generate more false signals. Ultimately, the smoothed Force Index provides traders with a more reliable tool for identifying significant market movements and making more informed trading decisions. One of the primary applications of the Elder Force Index is trend confirmation. The force index helps traders determine whether the current price trend is supported by volume and momentum. In an uptrend, the force index should generally remain positive, indicating buying pressure supports the price rise. In a downtrend, the force index should stay negative, confirming selling pressure is pushing prices lower. When the force index moves against the prevailing price trend, it may signal that the trend is weakening and a reversal could be imminent. To effectively use force index for trend confirmation, remember these key principles. In an uptrend, the force index should generally remain positive, showing strong buying pressure. In a downtrend, the force index should stay negative, confirming selling pressure. When the force index moves against the prevailing price trend, it suggests the trend is weakening. Focus on sustained behavior of the force index rather than temporary fluctuations for more reliable signals. Divergences between price and the force index often signal potential reversals. Let's examine how divergences appear on price charts and the force index. A bullish divergence occurs when price makes a lower low, but the force index makes a higher low. This pattern suggests weakening selling pressure, as sellers are unable to push the force index to new lows despite lower price points. Conversely, a bearish divergence happens when price makes a higher high, but the force index makes a lower high. This indicates diminishing buying pressure, as buyers are unable to push the force index to new highs despite higher price points. These divergences between price action and the force index provide early warning signs of potential trend changes, allowing traders to prepare for reversals before they fully develop. Force index zero-line crossovers are significant signals that can indicate potential trend changes in the market. Let's visualize how the force index behaves when crossing the zero line and what these crossovers might indicate. When the force index crosses above the zero line, it indicates a shift from negative to positive force. This is potentially a bullish signal that indicates a new uptrend may be forming. Traders often use this crossover as a buy signal, especially when it aligns with the overall trend of the market. Conversely, when the force index crosses below the zero line, it signals a shift from positive to negative force. This could indicate a potential new downtrend forming. Traders often use this crossover as a sell signal, as it may indicate weakening bullish momentum or increasing selling pressure. While force index zero-line crossovers can be used as simple buy or sell signals on their own, they become more powerful when combined with other technical indicators. Consider confirming signals with trend indicators like moving averages or MACD. Look for supporting volume patterns and always take into account the overall market conditions. These signals tend to be more reliable when they align with signals on longer timeframes. To summarize, force index zero-line crossovers provide valuable insights into market direction. When the force index crosses above zero, it indicates positive force and a potential uptrend. When it crosses below zero, it suggests negative force and a potential downtrend. While these crossovers can be used as basic buy or sell signals, they're most effective when combined with other indicators and tend to work better in trending markets rather than ranging ones. The Elder Force Index can be applied to any time frame, from intraday charts for short-term trading to weekly or monthly charts for longer-term analysis. Short-term traders typically use a 2-period EMA on 5-minute charts for day trading signals. These shorter time frames generate more frequent signals, but with higher noise levels, making them less reliable. Position traders, on the other hand, often prefer a 13-period EMA on daily charts. These longer time frames produce fewer signals, but they tend to be stronger and more reliable for identifying significant market moves. When selecting the appropriate time frame for using the force index, traders should consider their trading style and objectives. There's an important trade-off to consider. As you move from shorter to longer time frames, signal frequency decreases while signal reliability increases. Day traders may prefer the higher frequency of signals on shorter time frames, accepting the lower reliability, while position traders typically favor the higher reliability of signals on longer time frames, despite their reduced frequency. Section 10. Limitations and best practices of the Elder Force Index. Like all technical indicators, the Elder Force Index has important limitations that traders should understand. In choppy, sideways markets, the Force Index can generate false signals that may lead to unsuccessful trades. Additionally, during rapid price changes, the indicator may lag, potentially causing delayed entries or exits. To use the Elder Force Index effectively, traders should follow these 4 best practices. First, avoid using the Force Index in isolation. Like most indicators, it works best when combined with other analysis tools. Second, always confirm Force Index signals with price action or other technical indicators to reduce false signals. Third, adjust the EMA period of the Force Index to match your specific trading timeframe and style. Finally, be aware that extremely high or low Force Index readings often precede retracements rather than continued momentum. By understanding these limitations and following these best practices, traders can use the Elder Force Index more effectively as part of their trading strategy.